If AMD is right, Wall Street's models are way off. The company says its data center business can grow around 60% a year, hit $100 billion in annual data center chip revenue by 2030, and push earnings per share toward $20 in the next 3 to 5 years. But analysts are still modeling AMD like a normal chip company. So in this video, we're going to answer one big question. Are AMD's numbers realistic, or is this just another AI bubble story? We'll break it down into 3 parts. Number 1, what AMD is actually planning with MI450 Helios and the OpenAI megadeal. Number 2, the bull case. Why consensus might really be too conservative. And number 3, the bear case, the risks that could blow this up. This is not financial advice, just a deep dive to help you with your own research. For years, the story has been simple. Nvidia owns AI data centers, and AMD is the challenger. Nvidia doesn't just sell GPUs. It sells AI factories, the chips, the memory, the networking, the software stack, and entire rack-level systems. Because of that, Nvidia has been earning insane margins. Customers complain about pricing, but they still buy because the total cost of ownership is good enough and the software just works. Now the picture is changing. AMD's data center business has quietly grown into a serious operation. It's already running at about a mid-teens billion-dollar annual run rate, driven by EPYC CPUs and its Instinct MI300 and MI350 accelerators. At its latest Analyst Day, AMD basically told Wall Street, "We're just getting started." They're going directly at Nvidia's moat with 3 big moves: a new 2-nanometer GPU platform called MI450, a rack-scale system called Helios, and a massive multi-year GPU supply deal with OpenAI, alongside deployments with Oracle, Meta, and others. Let's start with MI450 and Helios. At the OCP Global Summit, AMD unveiled Helios, a full rack-scale AI platform built around its upcoming MI450 GPUs. Here's why that matters. First, advanced process technology. MI450 is built on TSMC's 2-nanometer node for the main compute die. That should deliver a big jump in efficiency and performance per watt versus current 3-nanometer parts. Second, rack-level design. A single Helios rack can pack up to 72 MI450 GPUs. Each GPU is paired with next-gen HBM4, and at the rack level we're looking at roughly 31 terabytes of HBM. AMD says that's about 50% more memory than Nvidia's upcoming Vera Rubin rack platform. So AMD isn't just selling a chip and leaving the rest to the customer. It's offering a full AI factory, very similar to Nvidia's HGX strategy, but with more memory and a 2-nanometer compute die. And customers are already lining up. Oracle is slated to be one of the first big public deployments, planning around 50,000 MI450 GPUs starting in 2026. But the headline partnership is OpenAI. Over the next several years, AMD will supply hundreds of thousands of GPUs to OpenAI, roughly 6 gigawatts of AI systems. AMD expects this relationship and related business to drive tens of billions of dollars in annual revenue at maturity and more than $100 billion in incremental revenue over 4 years. On top of that, AMD structured the deal with a big warrant. OpenAI can buy up to roughly 160 million AMD shares at 1 cent each, but only if AMD hits certain milestones, including MI450 shipments and share price levels all the way up to $600. That gives OpenAI a direct financial incentive to see AMD succeed. So when people say consensus estimates are stale, this kind of deal is a big part of why. But hardware isn't the whole story. Historically, AMD's biggest problem wasn't silicon, it was software. Nvidia has CUDA, CUDA, TensorRT, and a full stack that data scientists already know. AMD's answer, ROCm, felt half-baked for a long time. Weaker documentation, limited framework support, and painful porting. That software gap hits total cost of ownership directly. Even if AMD's GPU is faster or cheaper, it doesn't matter if your engineers spend months fixing issues that don't exist on Nvidia. In the last couple of years, AMD has gone after this seriously. It's been acquiring AI software startups and server maker ZT Systems to harden the stack. ROCm has improved to the point where some customers say porting workloads from Nvidia can now take days instead of weeks. And independent research from Stanford, the HipKittens project, showed that when you tune kernels for AMD's CDNA GPUs, they can match or even beat Nvidia's Blackwell-class baselines on key workloads. That doesn't mean CUDA is going away, but it proves the hardware is not the bottleneck. Today, AMD is becoming a viable second platform for big AI customers who want competition and an open ecosystem. Next, let's talk about demand. Why is AMD so confident it can grow its data center segment around 60% a year and still have room to run? Part of the answer is AI scaling laws. Studies of frontier model training show that the compute used tends to grow at a very fast exponential rate. Training a single state-of-the-art model can now cost hundreds of millions of dollars in compute, with hardware stacks in the billions. And that's before you even think about inference, actually serving these models to billions of users. It's also a global AI race. It's not just the US hyperscalers. Europe, the Middle East, and Asia are all trying to build their own AI champions and sovereign compute. Each one of those initiatives needs massive GPU and CPU capacity to stay competitive. AMD's twist is that it doesn't just sell GPUs into this wave. It sells EPYC CPUs as well, which are critical for AI agents, orchestration layers, and a lot of inference pipelines. AMD is already gaining share in data center CPUs and is targeting something like half the data center CPU market over time. Now, what does all of this mean for the stock? At its Analyst Day, AMD talked about growing company-wide revenue in the mid-30% range, growing data center revenue around 60% per year over 3 to 5 years, and pushing earnings per share toward $20 in that same window. Meanwhile, a lot of Wall Street models are still showing single-digit to low-teens EPS by the late 2020s and much lower growth assumptions. That gap is exactly why some investors say consensus estimates are stale. The article we're analyzing goes even further with a blue sky scenario. If you assume 80% annual growth in data center revenue for 5 full years, strong operating leverage, and reasonable share count control, you can model EPS north of $60 by around 2030. Even at a modest 26 times earnings, that kind of math gives you a hypothetical stock price well above $1,000 per share. Is that possible? Maybe. Is it a base case? Definitely not. In reality, you run into limits: foundry capacity, power and data center construction, competition from Nvidia and custom ASICs, and macro cycles in capex. Let's balance the bull case with the bear case. Number 1, Nvidia can fight back on price. If AMD starts taking meaningful share, Nvidia can cut prices, compress margins, and make it harder for AMD to offer a better TCO. That would hurt profitability for both companies. Number 2, execution risk at 2 nanometers. MI450 relies on TSMC's 2-nanometer node, advanced packaging, and huge HBM4 demand. Any delays or yield problems can push out volume shipments and delay the big OpenAI and Oracle revenue ramp. Number 3, hyperscaler ASICs and an AI capex slowdown. Google TPUs, Amazon Trainium, Meta's ASICs, and others could handle more inference and some training, capping GPU demand in certain areas. If AI spending cools off due to macro or investor pressure, both Nvidia and AMD would feel it. Number 4, software and support. Even with big improvements, CUDA is still the more mature ecosystem. AMD has to prove that ROCm, drivers, and support can scale to hundreds of thousands of GPUs without nasty surprises. Finally, valuation risk. AMD is already priced as a key AI player. If the company stumbles on growth, margins, or timelines, the stock can be extremely volatile. So where does that leave us? On the bull side, AMD is already running at a multi-billion-dollar data center revenue rate, targeting $100 billion per year in data center chips by 2030, shipping 2-nanometer class GPUs with memory-heavy rack solutions, and signing massive deals with OpenAI, Oracle, Meta, and others. On the bear side, you have a high starting valuation, intense competition from Nvidia, heavy dependence on TSMC and advanced packaging, the risk of an AI capex slowdown, and a software ecosystem that, while improving, still trails CUDA. My balanced view is this: AMD looks like a high beta, high risk, high reward way to play the AI data center supercycle. If Nvidia is the blue chip AI infrastructure name, AMD is the torque. More upside if they execute, but more volatility if they stumble. If you're a long-term investor who believes in the AI demand curve, AMD's execution under Lisa Su, and the need for a second big GPU supplier, then AMD is a name worth studying deeply. If you're uncomfortable with big swings and execution risk, it might be better to just watch this one from the sidelines. Let me know in the comments. Are you Team AMD, Team Nvidia, or are you avoiding both until the AI dust settles? If you found this breakdown helpful, hit like, subscribe, and share this video with someone who's trying to understand the AI chip war. This is not financial advice, just one more data point for your own research. Thanks for watching.